the next leg of it is the trade, right? So is the trade deals, right? And so the administration is basically using all their executive powers to get, the big ask in these trade deals are direct investment. Um, and they're using executive privilege either via thesis or tariffs, right? So that allows the administration to get the needed investment without going through Congress.
Well, hello there, my friends. Chris Mark is here with you for Arcadia Economics, and I sure am quite excited today because everyone watching at home, well, maybe not everyone, but a lot of you have heard me talk about Michael McNair, who had quite an interesting paper a couple months ago that was pointed out by Luke Groman, who we had on a little while ago. And Michael was writing about some of the things that he saw based on Stephen Miran's plan and his large thesis, 41-page paper of how to restructure the global trading system before he became the chairman of the Council of Economic Advisors. And Michael, it's quite impressive what you've done, and it's an honor to have you here today because I think, especially at this particular time, a lot of people are confused by what's happened. We saw the dollar index spike right after Trump got elected, gone down quite a bit since then. We've heard comments about how almost everyone in the cabinet talks about the overvalued dollar, and especially with tariffs going on. A lot to explain, and it's quite a pleasure to have you on in here to break this all down for people. So welcome on in. How are you today, sir?
Well, thanks so much for having me, Chris. Like I said, we were talking. I, have kind of covered the gold miners for almost, gosh, 18 years now, and as part of my coverage. And so I've come across your work, over the years, and so it's awesome for you to have me on. And I'm excited to kind of delve into the world of, global trade and capital flows. So hopefully we don't put anybody to sleep talking about balance of payments and accounting identities. But I think that what we're kind of talking about is really essential to kind of understand what's happening, in global financial markets. So yeah.
Well, I certainly agree. I think people are in for quite a treat today. Real quick, before we dig in, we'll just take a quick look. We're recording on Tuesday, August 12th, right afternoon. Gold futures are right under 34, silver right over 38. Quick bit of news. We had the CPI this morning, which a bit elevated still, even if under Wall Street expectations. Seems like Donald Trump still wants rate cuts, now threatening a lawsuit against Powell. So plenty happening, and I'm sure we'll be referencing this one quite a bit, Michael. Here is the dollar index, and again, we can see that move that began shortly after the election and went up over the 110 level, now down to the 98 level. I've been wondering, based on many of the things that you highlighted in Miran's paper, they talked a lot about an overvalued dollar, and we've seen this plunge. Has it actually been happening? And with all that said, as you've pointed out in a great paper that you just recently wrote, of which the link is in the description field below, you said that it starts really with an understanding of what's happening with the balance of payments, why the U.S. is running persistent trade deficits, and also what the administration is really trying to accomplish. So, with that said, why don't you take it away from there?
Yeah, thank you, Chris. Yeah, whenever I'm kind of describing, a system or trying to explain something, I really like to start with kind of the first principles, and that is going to require us talking about the balance of payments. And so that's going to help us understand the logic behind the administration's moves and understanding that there really is a strategy um, and kind of put into context, why the dollar's moved and why rates are doing what they are doing. But first we kind of have to talk about, you know, some of the logic behind that. And so I always start when I'm talking about trade, going with the balance of payments. And you know, it's because most people, when they're focusing on international trade, they're only, focusing on the exchange of goods and services. But that's only really capturing half the picture. So when money's crossing borders, it's going to do so in kind of one of two ways. And that's either through buying things, which we'd say a trade flow, or it's buying financial assets. So we'd call that a capital flow. So those two flows are actually inextricably linked kind of through what economists call the balance of payments. So we can express that in a really simple equation, but that is the trade account equals the capital account. Now, technically, it's the current account equals the capital account, but find people get current account and capital account confused. So they're slightly different, but I'm using the trade account here just for simplicity's sake, for the purpose of our discussion. So it's the trade account equals the capital account. So that means that any change in one side of that equation, it has to be matched by an equal and opposite change in the other. So the essential point is that financial transactions, like a country buying U.S. bonds or U.S. equities, that can impact the trade account and vice versa. So practically, as an example of that would be, a Japanese pension fund that's using its trade earned dollars. So to invest, say, $1 billion in U.S. tech stocks, that's going to automatically cause U.S. net exports to decrease by $1 billion, despite that transaction having nothing to do with the connection with, like, in goods and services. And that is something that I don't think people, you know, typically understand, but it's an essential point to understanding the logic behind the administration's, entire strategy, right? And the issue that I think people miss is that, 100 years ago, global capital flows were very small. It was mostly for trade financing, so they're connected to trade, and trade flows dominated capital flows. That is completely reversed today. So today, global currency transactions dwarf trade flows, 100x trade flows.
No.
So what ends up happening is that what it means is that capital flows today aren't just a response to trade imbalances, but they actually are a primary driver of trade imbalances. So that explains why, tariffs and other traditional trade tools that only address one side of the equation have often failed to rebalance the economy. So policy requires you looking and addressing both sides of the balance of payments. And so we're going to get into that in how they've done that this time. But I think the next thing that we probably need to cover is, there's also kind of a common mistake where a lot of people will equate trade surpluses with some sort of superior production capabilities or higher productivity, whatever. But that is not what a trade surplus is telling you. So the trade surplus simply tells you what the gap between what a country produces and its domestic demand. So if you're running a trade surplus, your production is higher than domestic demand, and vice versa if you're running a trade deficit. But what's important is that external forces beyond kind of your country's control, like a foreign entity buying your financial assets, will affect your trade flows, right? And likewise, domestic policy choices in a country, say like China, that implicitly tax consumption and subsidize production, that's going to increase production relative to consumption. And there has to be an offsetting deficit somewhere. And so domestic policies in other countries can have an effect on the U.S. domestic, you know, trade balance. And that's exactly what has happened, right? So, um, what has effectively happened in China is that they have a policy where, through various policy measures, they suppress consumption and effectively tax consumption in order to subsidize production. So that forces domestic savings rates far above what's needed for domestic investment. And so then they have to export that savings. So the Chinese don't buy our debt because they're doing us a favor. They buy our debt because they have to place those excess savings somewhere. And, if you call our balance of payments equation, it's, if China's buying our financial asset, it automatically reduces U.S. net exports. So the point is that the U.S. runs a trade deficit because it's been forced to absorb nearly 100% of the world's excess savings, right? So the net capital flows. And it's due to the fact that the U.S. is the only country that allows the free flow of capital and a sufficiently large financial system to kind of absorb those capital flows. So, yeah, that has led to this situation where the United States has run, for 40 years, persistent trade deficits. And likewise, China and Japan have run persistent surpluses. And I think I'm a big financial history buff. And so, I think one thing that is important for people to understand is that situation of persistent imbalances is completely unnatural and unhealthy. It's
Right.
not supposed to be where countries run persistent imbalances. And the reason why is that the entire point of a properly functioning trading system is that those imbalances are supposed to naturally reverse. And the trading system contains mechanisms that allow that to happen. So for example, when one country, if you're running a trade surplus, right, what is supposed to happen is that your currency, so it creates, or a deficit in this case, let's say if you're running a trade deficit, that creates a surplus of your currency versus the surplus country, which naturally is supposed to cause your currency to depreciate. So, in the case of an appreciating currency, that rebalances trade through two channels, right? So it's increasing your production costs of the surplus country relative to its trading partners, so making them less competitive. But just as importantly, it simultaneously raises real household disposable income. Since savings is equal to production minus consumption, that combination of higher relative production cost and increased household purchasing power naturally reduces the trade surplus, right? And so the principal goal is to allow for these, of a properly designed trading system. You're supposed to allow for temporary imbalances, but it contains mechanisms that automatically reverse over time. So under the gold standard, the way that occurred was mostly through relative inflation rates, right? So one country would get gold that would increase their monetary base, set off inflation in the country getting gold that was running a trade surplus, and the country losing would see relative deflation, and those relative inflation rates would rebalance the trade imbalance. But that's a pretty brutal means of rebalancing because well, it, it would work if countries followed the rules of the game, which is to fully allow those gold flows to inflate your monetary base and create inflation. Now, the problem is that domestic conditions were all sometimes such that that wasn't politically, you know, um, you know, right for, certain, I guess, politicians running for reelection didn't always want to have that inflation. That occurred, in the run up to the Great Depression in the United States. They did not allow the gold flows. They were getting them in France were getting all the world's gold, and they didn't allow it to inflate their monetary base. They were sterilizing those gold flows. And so that created a need for deflation in the rest of the world to rebalance. And that deflation is particularly brutal because the wages, are sticky to the downside. And so they typically only go down via extremely high unemployment rates. And so that's what led to the Great Depression. And it's a brutal means of rebalancing. And so, the Allies meet at Bretton Woods and they create a system where they of flexible, exchange rates where it was now it's not just inflation rates, but relative currency values can change to allow that rebalancing process to occur more naturally. Now, the problem is that countries have gamed the system so that the exchange rates haven't been allowed to adjust properly to rebalance global trade, right? So the United States is the only country in history to run large, persistent trade deficits for over 4 decades, all the while simultaneously seeing their currency appreciate by 350% over that time. That completely defies the fundamental economic principles where persistent deficits should trigger currency depreciation and automatic rebalancing. So the only explanation for that paradox is that the direction of causality is reversed. So it's not American consumption driving our deficits, it's inelastic demand for for American financial assets that are forcing those deficits upon us, right? So remember, there's two distinct drivers for currency demand. There's demand for goods and services, those are the trade flows, right? And the demand for financial assets, the capital flows. So the reason why currency has, appreciated, the US dollar is appreciated despite these persistent deficits is this persistent bid for US financial assets. And it's basically effectively short-circuited that natural currency adjustment mechanism, right? Whereby those large trade deficits should have led to dollar depreciation. But the dollar has remained strong because of overwhelming kind of foreign demand for US financial assets. And so that's how, I mean, the balance of payments basically, there's no, it presumes no direction of causality, right? So a trade deficit and its corresponding, capital account surplus can be the result of higher U.S. demand for foreign imports than foreigners have for U.S. exports. Or it can be the result of higher foreign demand for U.S. financial assets than American demand for U.S. for foreign financial assets, right? But it's the change in the currency values that tell us the direction of causality, right? So there is no way for the currency to appreciate while you're running a trade deficit unless the that is being driven by the demand for US financial assets, right? There's no other way you can that it can happen. Um, and so that tells us the direction of causality. The other way is like countries that actually need foreign capital to fund their deficits. There's a very obvious picture of what that looks like. That's Latin America in the 80s, Asia in the 90s, Turkey today. What you see is like the currency's in free fall, sky high interest rates, very low valuations on their financial assets. That could not be further from the truth of what we see in the United States today. So what that tells you is the direction of causality is a persistent bid for U.S. financial assets that are driving the U.S. trade deficit, and not the other way around. And, you know, the reason that's important is because it really makes a difference how you go about rebalancing. And so we get to the administration's goal. So this is the way Stephen Miran, is thinking about it. And from reading Secretary Bessent's old, investor letters, he thinks this way as well. And so with that being said, what seemingly the administration has done is only focus on the trade account with tariffs. And I think maybe we should go back and just say that also explain that the U.S. is, the reason why that persistent bid is for U.S. financial assets is happening is because of fundamental policies in countries like China where they suppress domestic consumption and subsidize production. So there's that persistent bid for U.S. financial assets. And so, a lot of people like this fundamental imbalance that has occurred, is a telltale sign that the current trading system is broken. And it's, why the administration is fully justified for wanting to redesign it. And in fact, it's actually negligence that we have allowed this to occur for as long as they have without actually doing anything about it. Now, one president or another has given at least lip service to that, but they haven't done the necessary steps to actually change anything. And I think it's also worth mentioning, people wonder why is the U.S. the only one seeming to complain about the current system? And the reason why is that the U.S. is the one that's being forced to run the persistent deficits. They're one that are bearing the burden of this. So, I mean, I read a lot of old contemporary sources from when I'm studying the markets from, days past, right? I go to the library and read old newspapers, and it's crazy. It's like you start to see it's like countries back then, they were constantly bickering and complaining about domestic policies in other countries that were forcing their country to run deficits and them needing to, allow gold to filter up to have more inflation to rebalance, things like that, right? But back then there was this back and forth, But for the past 40 years, it's been one country that has been bearing that burden. And we've just sat back and accepted it. I mean, it's utter negligence that they've allowed that to happen. And so the US is the one that, yeah, I mean, rightly so, the one that is complaining because we're the ones that have been running these deficits. And like I said, these are not natural. They can only occur because of what it, won't get too far into it, but it has to do with the distribution of income within these other surplus countries that force these U.S. persistent deficits. So, when people say, the U.S. did not start the trade war at all. It was, and when people, I laugh because people will say that, they're against the U.S. trade war because, they're for free trade. We do not have a free trade system. People just don't realize that, they only think about tariffs. But in fact, any policy that increases production relative to domestic demand and consumption is a form of trade protection. And in fact, a lot of these policies are far more effective in creating that trade surplus than a tariff. And so the US is reacting to these beggar thy neighbor policies that are gone up around the world in Europe, all throughout Asia. And that is the reason why, like, Donald Trump is not the cause of the trade war. He is the result of the trade war.
Okay.
So anyways, it's a long way of kind of setting the stage here, but I think that takes us to kind of the next point, which is, why the US, what is the US planning to do about it? And that's the whole strategy that Stephen Miran, put in his post is like, these are all the mechanisms the US has at their disposal. And I think everybody knows about Donald Trump's, affinity for tariffs. And
Although, Michael,
yeah,
one quick question just before you begin that. A lot of what you were saying reminds me of something I heard Luke mention probably about a year ago, where he said that also the realization that the flaws of this current system, it isn't just, people on YouTube or gold or silver bugs, but that within Washington and especially within military circles that have prominent decision-making power, they've realized that we're kind of at a point where something has to change. When if you could comment on that and then lead into
yeah.
what they're doing now.
Look, I wrote a paper 15 years ago saying a trade war was inevitable, right? It was bound to happen, and people thought that was absolutely insane. And maybe it's hard to remember, what the thinking was back then, but for me, it was inevitable. Like the system was going to only continue to do the same thing that it was always doing, which was forcing persistent deficits upon the United States. And that burden was showing up as higher government debt. When you have capital, when you accept capital flows, it forces an adjustment in your country, and it's one of three bad things, right? So either higher private debt, higher public debt, or more unemployment, right? Because if you are consuming 100 widgets, and you're only producing 80, you have to finance that 20, widget deficit with by, giving over assets. And today that's the form of debt. It used to be gold, for example, that would, you know, balance that. But so it creates a persistent, need for, and the United States has chosen to not allow it to create unemployment. And, during the mid 2000s, we allowed it to set off, a housing bubble on the private sector leverage cycle. And after that bust in the financial crisis, it's been entirely up to the U.S. government to increase the debt to allow the U.S. economy to continue to grow while, we're losing 5% of GDP out of, through the trade account a year. I mean, it's unbelievable, but that's what's been forced to happen. So ever larger government debt is needed to balance that. And so my question when I made that, you know, proclamation that there would be a trade war was what's the impetus? At the time I thought it was the financial crisis. Is like, okay, currently, yeah, and maybe that's it. And then, you know, maybe it was the European debt crisis. I mean, that was a classic balance of payment crisis, you know, from the southern, the periphery versus the northern Europeans that were running these offsetting, persistent imbalances. That wasn't enough. And so I was like, what is it finally going to take to finally get people to realize that it's not, it's not you know, that this is actually a burden, being the reserve currency is actually a burden on the U.S. economy. And it turns out it was partially just the rise of China, and it got to be such a point during COVID and then the Ukraine war where it became so glaringly obvious that we have put our national defense um, in extreme jeopardy because of this, maintaining this, global trading system um, that has kind of gutted U.S. manufacturing. It is, in running persistent U.S. trade deficits. So that seems to be it. And I agree with Luke. I think there is a big, you know, behind the scenes, the DoD that is helping drive this policy. Um, I'm not so sure that this is necessarily something Donald Trump wishes he had to deal with in his presidency. It's certainly an incredibly difficult nugget to tackle. And um, it can be politically difficult because people don't understand, the nuances of, the balance of payments and why all these things are happening. And it just looks like the United States is starting a trade war, when in fact, it is responding to beggar thy neighbor policies around the world that create this persistent imbalances. And the system needs to be changed. And in fact, it is those persistent imbalances that are the smoking gun evidence that the trading system is broken, because that is not the way the trading system is supposed to happen. You're not supposed to have that because, again, of the way that the trading systems, a properly functioning trading system is supposed to be designed, which is to reverse these imbalances, right? Um, and so, yeah, I mean, I absolutely agree with Luke. And it is unfortunate now that we put ourselves in a very difficult position where our global supply chains are reliant on our biggest geopolitical rival. And from that perspective, it explains the big reason, to put tariffs on is because, they're very disruptive, but it serves a vital purpose. It's forcing companies to rebuild resilient, secure supply chains before, a crisis makes that orderly transition impossible. When you're in a hot war and all of a sudden you're trying to rebalance your supply chains, it's going to be a lot worse than, doing it now. But, there is a way, like, tariffs do rebalance trade flows. It's effectively it's a tax on domestic consumers whose real incomes decline, and a subsidy to domestic producers whose prices, fall relative to their foreign competition. So in that aspect, effectively a tariff is effectively the same as a currency depreciation, right? And the way that rebalances flows is, it decreases domestic production costs, this, and while simultaneously decreasing real household disposable income, right? Because that same dollar of income is worth less than, when the dollar falls, right? So um, basically it's shifting resources from domestic consumers to domestic producers. But what's important to understand is that consumers are also producers. So in the current arrangement that subsidizes consumption while penalizing production in the US, you're ultimately undermining the income generation, of the economy. And it requires increasing debt levels to maintain living standards. So the apparent gain in purchasing power is offset by, reduced employment opportunities, lower wage growth, and industrial hollowing out. And so, but kind of economists in classic kind of reductionist style, they only focus on the tax, like who's paying for it, without considering the income effect, right? So rebalancing is about supporting American income rather than needing debt levels to maintain living standards. And so that's what a tariff does. But the problem is that going back to our issue is that focusing only on the trade count is not going to rebalance the US economy, right? And tariffs also don't attack the source of distortion that drive the global trade imbalances, which is the persistent capital flows. So, um, capital still drives trade outcomes, right? And if countries continue buying US financial assets, then tariffs aren't going to correct the imbalance. And we actually had that exact example in 2008. Sorry, in 2018, right? So the U.S. placed over $360 billion of tariffs on foreign goods. But do you know what happened to the U.S. trade deficit when that happened?
I do not.
It actually expanded. And if I have a fantastic chart, it's like you will see the trade balance, and as soon as tariffs went on, the trade deficit expanded, right? So the US trade deficit with China fell $40 billion, but the deficit with the rest of the world increased by $100 billion, right? And the reason why is that they did not address the capital account. So what ended up happening, the dollar increases by 10% and it offsets the tariffs. So and the reason why is that relative US interest rates increased because countries reacted to the tariffs by lowering interest rates. And that created this big interest rate differential in the United States, as well as the dollar. It created, there was this big safe haven flow trade that went. And so capital came into the United States. So despite putting $360 billion with the tariffs on the rest of the world, the US trade deficit expanded. And it's because they did not address the capital account. And at the time, I was very critical of their handling of kind of this attempt to rebalance the economy. And, I have, you know, been pretty, I've been advocating for them to address the capital account, um, you know, this time around. And I'll say that I've been doing that, but, effectively saying putting in capital flow tools, right? So these are things like capital flow taxes, things like that, right? And I think one thing to understand is the reasoning behind that is that you can only do two things with the dollars, right? You can either buy U.S. goods and services or buy U.S. financial assets. Now, some might argue you can do things like buy commodities and things like that, but that just transfers the decision to somebody else. Currencies always come back to their place of origin, right? That's why the balance of payments balances. So when you decentivize buying U.S. financial assets, it is incentivizing buying U.S. goods and services with that. And so that's the whole logic of why you would put in capital flow taxes, right? It rebalances the economy. Um, Now, what brings us to my most recent report is, the dollar squeeze note that I have, is that the administration did something incredibly ingenious in the way they addressed capital flows this time. So they didn't have to, create formal capital flows, capital controls, right? Which requires legislation, and you know, there's a lot of headaches that come with that, right? And politically, and with your rivals, right? So what I've shown in my recent report is that the administration actually used a market squeeze to basically address the capital count rather than um, you know using formal capital controls. And so, I mean, I can stop right there if you have any questions on that, or we can kind of dig into kind of the specifics of how they managed to do that.
Yeah, I'd love to hear that part, especially what specifically they've been doing, because you talked quite a bit about that. And again, I'll mention the article is in the description field below and was quite fantastic. But fortunately, we have you here. So if you could walk through
Yeah.
what you addressed in there, that would be fantastic.
So it's interesting because it's something I don't think hardly anybody in the world really understood what they've done. In creating these capital outflows. But people might have noticed that, oh, like the dollar has fallen this time, when it increased, in 2018. But what's really important is to understand why that has occurred, right? And so in my report, the way I guess, kind of frame this is through showing that, the U.S. has run current account deficits, trade deficits persistently for 40 years. But the which requires, a foreign capital flows kind of financing those deficits, right? But what's important is that the the marginal investor kind of funding that capital, that current account deficit has changed over time. So, if we go, to the 2000 to 2014, we had central bank reserve accumulation, right? That was coming in, buying US debt, US financial assets, financing the US current account deficit. That was unhedged flows. So then we go to the next regime that I discuss is the 2014 to 2021 regime. In that case, it was other private, like pension funds, insurance companies in other countries that were buying US Treasuries, but they were doing so on a hedged basis, meaning when they would buy US Treasury, they would sell dollars forward so that they didn't have the currency mismatch, right? And then we get to the next regime, which is in 2021. So basically, from 2021 to the first quarter of 2025, the marginal, like the investor that it was financing U.S. current account deficit were those same private investors, but this time unhedged flows, right? And that's really, really important because so what happened is in when we got to 2021, this like regime three, the Fed delivered about 500 basis points or 500 basis points of hikes. And so we had this flatter US yield curve, and you had this really wide policy rate gap between the US and the rest of the world, so that the hedging costs basically ate up the entire yield pickup that you would get from investing in US Treasury versus, say, a JGB. So the real money investors decided to just do away, run the currency risk, and they dropped the hedge, and they just bought treasuries outright. So what made this regime very different is that for the first time we had unusually large open FX positions accumulated by balance sheet constraints institutions like Asian lifers, right? Um, and so that takes us into regime four, which is 2025. So they walk in to Liberation Day holding these historically large unhedged dollars positions. And essentially, they got caught with their pants down. Um, and what ended up happening is that, the Trump team signaled aggressive trade policies and potential dollar devaluation. And since they didn't have the hedges, to absorb the shock, every tick lower in the dollar hit their balance sheet directly, right? So Liberation Day hits, their VAR models light up, and they require forced selling. And so the dollar depreciates 10%, right? Versus 2018, where we have the first, Trump 1.0 tariff wars. These same investors had hedged their currency. So it did not require them to de-risk and sell those assets. And in fact, it actually created safe haven flows. So all the risk was at the dealer. And so it didn't, you actually had the opposite effect. The dollar appreciated 10%. This time, they engineered a short squeeze on these overexposed real money funds, in Asia and Europe that required them to sell US dollar financial assets. And as a result, we get $200 billion of capital outflows. And as a result, the US net trade, I mean, it's the biggest improvement in you know, in net exports basically on record. Um, and yes, there is some tariff noise in that, but the capital flow data and the FX relationships with rates and everything show that this is a real adjustment and it's going to be persistent. And right now they're getting no credit for this. Um, you know, so it's actually brilliant, right? So I think, the mechanism that they did is basically they, they basically used market signaling, these veiled threats, like things like potential withdrawal of swap lines, it was Section 899 capital flow tax threats. And all these balance sheet constrained investors that had massive dollar exposure, um, historically large, right, were forced to de-risk. And so we get capital outflows through a market unwind, Um, so, and they get, they don't have to, say that they were, restricting access to U.S. capital markets, right? I mean, they just say, oh, a VAR shock that creates 200 billion of capital outflows, that's just market dynamics, right? But it was really particularly elegant because of who they targeted. It targeted exactly the right pressure point. So to understand that is like, so central bank reserve building came under scrutiny, especially after the financial crisis. So a lot of these Asian policymakers, they found like a subtle way to kind of maintain their undervalued currencies, and that was their domestic insurance companies, right? So countries like Japan, Taiwan, Korea, they actively encourage and in some cases, mandated that their life insurers, accumulate foreign assets. Taiwan's, life insurers alone own 700 billion of mostly US bonds, right? With like 460 billion of that is completely unhedged. It's more than 60% of Taiwan GDP, right? I mean, it's just astronomical numbers. And so those insurers effectively became state proxies for currency management, keeping dollars bid and their home currencies weak, but without like the political baggage of official reserve accumulation. But critically, unlike central banks who can print money and bear unlimited losses, the insurers face real balance sheet constraints. So their assets are largely in US dollars, but their liabilities are in domestic currency, right? So the future policy payments, right? So they're in local currency. So that asset liability mismatch meant that a falling dollar hit their capital ratios directly. So, VAR limits and regulatory capital requirements and solvency rules made them completely vulnerable to exactly the kind of short squeeze that the Trump administration engineered. And, what basically had been a clever workaround for currency manipulation became a really critical vulnerability when Liberation Day hit.
Yeah. Yeah, that makes a lot of sense and helps to put a lot of things in context. And Michael, I know we're not out of time yet, although running up on our time for today. So there's two questions I have left. Obviously, before we let you go, I'd love to get your comments on gold and silver. And I know you mentioned that you've been analyzing gold stocks for a while too. So we'll leave that for last, but perhaps bringing this all to where we are now and what to expect going forward. You've enunciated what they've been doing. And obviously, the plan is a big part of the plan is to bring manufacturing back to the US. Now, it's interesting you mentioned earlier the problems with the reserve currency. So far, I've heard that, they talk about perhaps a different valuation of the dollar, yet still wanting to maintain that role of reserve currency. But based on everything
Yeah,
you said, are they going to be able to successfully get us to the point where it's not something that, I think a lot of people are concerned when they see the debt continuing to grow. Besson has talked about how part of the plan is to be growing faster than the debt. Will they be able to get there, and what would that look like?
yeah. I mean, the entire point of reversing the U.S. trade account is like, if you want to actually lower U.S. debt, you need to reverse the U.S. trade imbalance, right? And so, what ends up happening when, you know, essentially you end up having when you're accepting capital inflows, right? That in most countries that say export capital, i.e., run persistent trade surpluses, they see their income grow faster than the debt servicing costs, which steadily increases their capacity to manage debt, right? Now, of course, surplus economies can misallocate capital like China, and it still pushes up their debt to GDP. But that being said, if the United States wants to reduce its debt to GDP, they have to reverse their persistent balance of payments imbalance. And we just did that. For the first time, we're seeing meaningful adjustments there. And it's a result of driving capital finally going the other direction. Um, and so that's the only solution to the U.S. debt problem is to reverse that imbalance. And like when countries own U.S. financial assets, what that means is that that is a claim on future U.S. goods and services, right? So all those reserves and assets they have built up in debt, that's just future demand for U.S. goods and services. So what the administration is trying to say is like, rather than accumulating future claims on that, we want you to sell those, and which means buying U.S. goods and services with that. And so that is what needs to happen, which allows income to grow faster than debt. But until you reverse that imbalance, the U.S. debt load's just going to continue um, to build. And but I absolutely believe they're going to do everything they can to reverse that. And if you're wanting to see what the real the what it means to have the reserve currency and have that you know that power, like the US is using that right now. So yeah, and maybe worth also discussing about what the next leg of kind of the administration's plan is, because it kind of fits in as well with, if you were going to basically, in a way, tax consumption via tariffs and things like that, right? Then to allow the economy to continue to grow, you need to have investment growth, right? Now, I will say one other thing that people are going to miss is that, consumption can grow, or in demand in the US can grow slower, but if you stop the 5% of GDP of that demand going out through the trade account, but because you reverse the US current account deficit, then in demand can slow, but the total economy grows strongly. And that's what I think people are going to miss, where you know if we get a persistent reversal, like people are going to be used to looking at the old metrics and saying, oh, and not realizing like for the first time, like actually the trade balance adds to US GDP. So if you reverse a 5% current account deficit, like the other metrics within GDP just don't move that much. So you can you can have a slowdown without, in demand without actually having a recession if you reverse that current account deficit because you drive capital flows out. But the other really important thing that you need is you need to incentivize investment. And the problem is that tariffs and currency devaluation, they tend not to drive, you know, investment overnight, right? People don't just make those decisions immediately. They wait to see, oh, the currency, now it's gone down, it's more competitive to build here, whatever. Um, and so we get in a situation, it's like, what's going to drive that investment? And that is the next leg of the strategy that they have. And they are going to do that via basically the US government. Um, and so there's a number of mechanisms that, I was really wondering, um, in OBBA, like it didn't seem to have any like real like strong policies, that were to address really the industrialization, it didn't seem like. Um, well, it turns out there actually, first of all, there was, but it went very under the radar. And that one was the Office of Strategic Capital, right? So the OSC launched in 2022. It was a pilot inside the Department of Defense, and its mission was to finance critical minerals for dual use technologies. So the pilot was small. It was like, under a billion. But OBBA turned that pilot into this massive platform for reindustrialization, right? So it went under the radar because the actual lending authority, the appropriations that it wasn't that big. It was a billion, it was 1.5 billion. It was 500 million for critical mineral supply chains and a billion for, broader dual use technologies. But the critical provision was an accounting change. So instead of now counting the full loan amount against the budget, OBBA changed the scoring rules so that now they only account for the expected subsidy cost, which is basically the risk of default, which they, roughly like 1%. So the result, and then they say this in the bill, it's like 1.5 billion of appropriations gives OSC 200 billion in lending capacity. And that's actually just the start because there's another piece of legislation coming up. I thought of whether I should even say this because it is coming up for a critical reauthorization vote, but that is the International Development Finance Corp, or the DFC. HR 8926, the DFC Modernization Reauthorization Act. It has another absolutely critical accounting change that creates effectively the sovereign wealth fund, right? So what that does is that it, instead of making cost calculations on this net present value basis, where every dollar that they spend is acted like a grant, instead they're allowing them, sorry, that what they're the way that they're allowing them to count for this against the budget is basically on this net present value basis. So, you know, every $1 doesn't get scored like a full, $1 budget charge. It only reflects the expected subsidy, which is the net present value of the net present value of losses net of returns. So for a solid deal, that might just be $5 to $20 million per $100 million deployed. Sometimes it could be zero. And so it creates this massive investment engine. And so what I imagine it doing is the DFC acting like a first loss GP, basically taking subordinated equity stakes to crowd in private capital, right? So that way they can catalyze billions of strategic investment without absorbing the full budget hit, right? I mean, the multiplier on that is enormous. And this is why this DFC is suddenly being staffed with private equity guys, right? Leon Black's son tapped to, he still needs confirmation, but tapped to run it. And they are hiring, staffing right now full of private equity guys. That's why Donald Trump went to the Middle East and scored 2 trillion in pledges. But it's because they're gearing up to use the DFC as this massive private equity style funding vehicle for all these investments. And we keep getting these different, they'll leak little things in Bloomberg, and I have some, here's, I can read you some quotes, and it was from different reports that they keep putting out, right? So one quote from Bloomberg: one approach under consideration involves converting the U.S. International Finance Corp into a sovereign wealth fund. Bloomberg, that's from February. Another one: the administration is discussing plans to shift billions from U.S. aid to the DFC, transforming it into a more aggressive instrument for U.S. economic power, with an expanded role for private equity groups and investors. Another Bloomberg article: there seems to be a grand strategy, and the DFC appears to be the conduit of that strategy, said Solar, I'm not going to try to pronounce his name, founder of Global Policy Advisors, a sovereign wealth fund advisory firm, right? And so that's what's coming, right? So they're going to use this DFC as this massive private equity style funding vehicle to help fund these investments. The next leg of it is the trade, right? So is the trade deals, right? And so the administration is basically using all their executive powers to get, the big ask in these trade deals are direct investment. Um, and they're using executive privilege either via CFIUS or tariffs, right? So that allows the administration to get the needed investment without going through Congress, right? So like the recent Nvidia deal, right, is another perfect example. The Nippon Steel deal, they weren't going to allow that to go through until basically they said, look, we need 10 billion you to build, 10 more billion in new US steel capacity. And as soon as Nippon agreed to do that, they let it go, right? They approved the deal. So this is their strategy. And it's exactly why Donald Trump did not fear the political fallout from tariffs, right? And the reason why is there's going to be ribbon cuttings and mega project announcements with real jobs being announced one after another from now till midterms, right? And by not going to Congress to fund those projects, or at least the way that they're funding them, the legislation they did get allows the administration to kind of control those projects. So now the Trump administration controls where those projects are going, what they're going to be, and every contested district is going to get a project. Maybe even if their candidate wins, it might even be some sort of quid pro quo. I don't know, but you know they're going to sit there and say the reason why we did these tariffs is because we got these deals. And they're going to put real jobs there. There's going to be factories that are going up, and it's going to be, you know, what this reshoring of these supply chains that we've needed, but don't get funded under capitalistic, you know, incentives because we have competitors in places like China that invest in these places without concern for the rates of return, and so they drive down the returns in that area. And if you just sit back, then they will dominate those areas. But these industries are critical to be able to, for national security reasons. If you want to be able to wage a war, you need to have manufacturing. And so the only way that those are going to get done is by the US also subsidizing these areas. The way that if China is going to do it and you want to have any kind of capacity there, then you're going to have to do the same. But we've already seen, Navarro basically told a meeting that the floor price that they set for rare earth metals for MP materials earlier this month,
Mhm.
you know, they said that was not a one-off, and there's going to be plenty of more deals like that to come. And so we're going to see the next leg of the administration's kind of strategy is turning to domestic investment. And I mean, like we were talking earlier, like I don't want people to think that I'm some political hack that's just, supporting the Trump administration and with glowing praise. I am one of the most least political people you will see. You will never find anything on my Twitter, anything about, politics that doesn't deal with the specific area where I'm an expert in. And so on trade and capital flows, it happens to intersect with politics and that's fine. But I'm, you know, not just cheerleading, for the administration, but I am being honest that this is what needs to happen. And, I don't know if I would go about it the same way, but I will say that what they have done has been incredibly impressive in terms of being able to engineer, a capital account reversal, what I've said needs to happen. And they've been able to do it very elegantly. And, there's a long way to go, and this process is remarkably complex. They're trying to do a lot at once. And unfortunately, part of that is because the United States really doesn't have time on its hands. That is not, time's not an ally for us. And, I think the world is becoming a more dangerous place, and the U.S. is incredibly vulnerable right now because we don't have the ability to fight a long sustained war. And we found that out in Ukraine.
Well, Michael, it was a masterclass you just delivered there, and I can't thank you enough. I think this is one that I'll probably watch a couple of times because a lot of information in there, but I think you unraveled a lot of things that most regular folks have had a hard time seeing. Although, in the last minute we have left, perhaps real quick, any thoughts on how gold and silver fare during everything that you've laid out and are expecting to see over these next couple of years?
Well, the US dollar has been the reserve currency. Now, the problem is that that creates a burden on the US, right? And so there were some geopolitical benefits to that, but the economic and national strategic actually negatives have now decided the United States has said, okay, the dollar standard is over. So the issue is that countries in the rest of the world still are running these policies whereby they implicitly tax consumption, subsidize production. So it creates excess savings. So they need to put it somewhere. Well, the reason they put it in the US dollar is because it's only one big enough, liquid enough, and allowed people to put their capital there. Japan, you try to put that capital in JGBs like China did, and they told you what to do with it, right? They just said, no way, we're going to let that happen, right? Or what they do is they immediately take that out and they basically put those reserves into US dollars, right? So nobody wants to be the reserve currency. And we are running these beggar thy neighbor policies, domestic policies that create excess savings that need to go somewhere. And so where do they go? It's going to go into places like gold. And that is why we're seeing gold, ever since the Ukraine invasion. Like I used to have a just a simple three-factor model that looked at, liquidity, it looked at volatility, and it looked at real interest rates, right? And you could model gold. It completely uncoupled from that. And that is a result of a persistent need we have persistent imbalances, and those excess savings need to go somewhere. And the U.S. is not allowing it to happen, the dollar to be that source anymore. So the question is, where does it go? And the natural place is gold.
Well, I think that's a perfect capper. We get some smiles on the faces in the audience as we wrap everything up here. And again, I really can't thank you enough. This was beautifully done. And Michael, I know you publish a lot on Twitter. Perhaps you could just mention if people want to follow your work, where they can find you there. And I also have the link to the article pulled up.
Yeah, it's Michael J. McNair at Michael J. McNair on X or Twitter. And then I think you have my Medium post as well. Yeah, so hopefully, I try to put something out roughly like once a month, but I'm a little bit confined to, some guardrails of what I can actually publish publicly. But yeah, so I really appreciate Chris. It's been wonderful. This is my first ever podcast interview. So
Yeah.
I
Beautifully
yeah,
done.
I hope you
Beautifully
work.
done.
Yeah, sorry working with me and not having any experience in this at all, but it was enjoyable, and I always love the chance to get to, yap about global trade and markets and everything. So, yeah, it was a pleasure.
Yeah, well, it's like you said, there's things outside, yet you focus on what's your area of expertise, and this is certainly it. So I think this is going to be really helpful for people at a very critical time for our country here. And again, we'll have the link to your article and Twitter in the description field below. So, folks, if you found this helpful, definitely follow Michael. And Michael, thank you, my friend. Well, I'm sure in a couple months we'll be ready to do this again soon
Absolutely.
as things develop. And thank you again, my friend.
All right. Have a good one. Thank you.